Hi guys. So I wanted to chat a little bit about rates and how we calculate them. I keep getting the same thing this year about, well, rate's a rate, right? Like, why is it different? So let's unpack this a little bit. So first off, rates are really determined about how the economy is doing. So if the economy is doing well, we typically see higher interest rates. And if the economy is doing bad, we typically see lower interest rates. Sounds like it should be the opposite, right? Well, these rates are not rates that are given to consumers. They're given to banks to help consumers borrow money. Many people assume the Fed controls mortgage rates, but they don't. The Fed controls short-term interest rates and the money supply by increasing or decreasing them. When the economy is doing well, we'll see the Fed increase the rate to restrict the money supply. When the economy is doing not so well, we'll see the Fed lower the interest rates to help borrowers afford more. The real driver of mortgage rates is the mortgage bonds. So mortgage-backed securities. Mortgage bonds are bundles of mortgages sold on a secondary market. When the demand for these bonds is high, we'll see rates decrease. When the demand is low, we'll see rates increase. That's the major driver of mortgage rates. I now want to get into the base rate, but what now changes your interest rate and what makes it unique to each client. Each day when the market opens, lenders are given a rate sheet. That doesn't mean that's the rate for that day. It can change daily, but it can also change multiple times throughout the day. Think of it as the stock market and a certain stock you're watching, how it can go up and down throughout the day. That's how mortgage-backed securities work as well, which is the interest rate that we provide to consumers for their home loans. So we are all given these rates, basically driven from mortgage-backed securities. From there, we have government-sponsored entities, GSEs, which is basically Fannie Mae or Freddie Mac, that give the lenders LLPAs, loan level pricing adjustments. So now these LLPAs are given to us, and what they are is they break down into categories. So first, in an obvious one, will be credit score. We all hear the lower your score, the higher the rate. The higher your score, the lower your interest rate will be. So first factor in an LLPA is going to be your credit. The next could be your down payment. So the less down, the higher the interest rate may be. Also, that affects those rates in the LLPAs is a type of property. So if you're buying a single family residence, that'll carry a different rate than a condo or a duplex. Rates go up once you hit 2, 3, 4 units. So those all play into determining what the rate will be, and that's why a rate isn't a rate and it's unique to each client. I hope this video was informative and helped shed some lights on where we get our rates from and why there are adjustments and different rates for different clients. Again, happy to walk you through all of this, get you pre-approved, answer all of your questions. We're licensed in 49 states. Don't forget to subscribe. Check us out on any of the social media channels. Thanks.